All right. Welcome back to another episode of the Real Estate Investing Club, and happy Friday, everybody. It is always Friday here on the podcast. So I hope you guys are having a great day and we can bring you some of that Friday energy. We got Chris Lento with us on the podcast today. Chris is a multifamily guy. So this should be an interesting episode for all you guys out there who are interested in apartment complexes. Chris, thanks for hopping on the show.
Yeah, thanks for having me, Gabe.
Absolutely. Oh, and I forgot to mention EM Capital is Chris's company. I always forget one small detail when going through the intro. But Chris, I told you before we got on here, we always like starting with stories to hear how people got to where they are. So why don't you take us back to the beginning of your story in real estate and tell us how you got here?
Sure. So I'm from the Boston area. Graduated from college with a mechanical engineering degree and got a job at a defense contractor, effectively in the Boston area. And moved into a three-decker, which is kind of a apartment style that's really popular here in Boston, just three apartments on top of each other. And quickly it was like, oh, we're paying a ton of rent and there's 3 units. Like, who's making all this money and how much do these cost? And I just like kind of dove in. So I had my job and it was, fine. It was my first job. And started reading books and talking to brokers and just was really interested in this whole concept. And there was no podcasts and there wasn't a lot of like online stuff at the time. This was 2000.
Okay.
So it was really books. Like, I read a lot of books and talked to a lot of people. And then 2 years later, I bought a 4-unit in kind of a rougher neighborhood in Boston and lived in one, as people moved out, renovated them, increased the rent. And it went really well. And I was, it was interesting. So I kind of was doing that on the side, doing my regular job. That went well, was able to save enough money that I bought another one, moved into that one. So, same thing, used, standard financing where I could put, 10% down.
Yeah.
Because they were owner occupied.
Right. You were living in all these when you moved.
I was living in them.
Okay.
Yeah, exactly.
Okay.
And
then, this was a rougher area of Boston?
Yeah, it's kind of near the airport. It's actually, hugely gentrified now.
Yeah.
But at the time, it was not a very popular area. It wasn't dangerous or anything. It just was not a great area.
Right. Okay.
So I could afford it, really, and then I thought it was great. My plan was to just sort of add one a year or, every 2 years in parallel with my job. And I'd never really thought of it as like a career. And then the financial crisis hit and like everything went underwater, meaning that, the loan was worth. Oh yeah, like the loans were, at or above the value of the buildings, on paper at least.
Right.
But rental rates didn't change in Boston. Like, I was still paying my mortgage, still making the same cash flow. So it was a bit of like kind of an ego hit, like my net worth went down.
Yeah.
But on a daily basis, it didn't really change a whole lot.
And you didn't have variable rates. You had
no, I had 30-year AM fixed rates.
Yeah.
Because they were, residential mortgages. So at low rates.
I thought it is 4 units is the cutoff for residential to commercial. Yeah.
Yep.
Okay.
So I sort of saw it, but it wasn't, all it did really was make me more skeptical of real estate. It didn't like, blow me up or anything like that. But it did dampen my enthusiasm. So like during that time, it was like, all right, well, maybe I'll put this on hold for a while because it's not as great as I thought, but it's right. And then, I continued my career. And then shortly after that, started ramping it up again, did some cash out refis, grew that property portfolio up in the Boston area and got a lot more serious about it. So now I'm in my like mid 30s and thinking, all right, how do I make this a career? I got to the point in my career where I could see sort of where the trajectory was, and it wasn't that interesting to me.
Right.
It was a lot of travel. It was, I was an engineer, and now at this point I'm a program manager. It's a lot of travel, a lot of
flying
meetings,
here, going there,
flying to the West Coast. I had a daughter, and so I scaled up, and I came across the idea that, there's different markets have different cash flow profiles and different appreciation profiles, and that, your market isn't necessarily the best market to meet your goals. So how could I invest in other markets effectively. And, you always hear that you want to be in your backyard for real estate. And there's a value to that, but there's also a value to, targeting markets that have the right population growth and job growth, and, city planners that have a vision for the area. And, riding those waves can have a lot of value. So I started looking at target markets. I 1031 exchanged two of my properties into out-of-state properties, one in Tallahassee, Florida. Kind of dove into the world
Good
of
choice.
offsite property management. Yeah, right. I've dodged a lot of hurricanes since then, I'll tell you that. Um, and they've worked out really well. And then at that point, I felt like my model was solid enough and proven enough that I was confident in starting my company and moving to it full time in 2017.
Nice.
So
That's
sort of a long road, really. I mean, I was doing real
also
estate
really
for
good
15
timing.
years. Yeah.
Yeah, 2017, right before the hockey stick took off.
Right.
So nice. I like that a big part of your story is the selection of markets. So many people, like I'm in a West Coast city, coastal cities, we're looking at the markets that we're in. And like when I first started, I focused on multifamily, but I'm in Seattle and I'm looking at these numbers and I'm just like,
Yep.
how do you make this make sense? I mean, they're selling for like 4 caps, 5 caps, and it's just I could not make it make sense in my mind how this could be a career for somebody when you're buying at such a low cap rate and you just can't see that cash flow. And so you really started there. You're like, okay, I'm in a coastal city, but there are other markets that are more focused on cash flow where I can actually make this into a lifestyle. I can actually turn this into a business that brings me income to live on. Let's kind of start there and take that as the focus. How did you go about selecting the market? You mentioned Tallahassee. You were looking for cash flow. What did you do? Take us through, step by step. How did you go about selecting that?
Yeah, so I was looking for markets that I was going with the tide. So had population growth, job growth. We're going kind of in the right direction. And like you said, Boston's a coastal city, and there's always really strong rental demand because we're supply constrained, but the cash flow is so low because the prices are very high. So I was looking for mainly properties of the size that I could 1031 what I had into. So I sort of knew
Mm,
my buy box, and it was kind of narrow
mm,
because I had a certain amount of cash that I was going to roll. So I started looking in markets that I thought were up and coming, but not hot. So
okay.
I looked at the
And
Milken.
how do you define up and coming but not hot? Like what were
Yeah,
give
right.
me some
So
metrics that you were looking at?
yeah, so the Milken Institute puts out an annual best cities report,
You said
which I
Milken? I
like.
actually haven't heard of that one.
Yeah, yeah, the Milken Institute. It's a California institute, and
Hmm.
every year they put out a best cities report, and it's got a lot of metrics in it, like tech job growth, cost of living, innovation. It's not a multifamily report. It's kind of like a city rating.
Mm-hmm.
It breaks it up into top tier cities and second tier cities by population, and it gives you a good kind of yardstick to say what cities are going in the right direction and what aren't.
Yeah.
So at the time, I was looking. I wanted to see cities that had a big jump, but were not in the top 50.
Okay.
And
Not in
I'm
the
not
top
saying that
50 in
that's
terms of population or in terms of growth.
no of their best cities ranking. So I like to be in a city
Oh,
that has
got
at
it.
least 200,000 population. So I don't want to be anything smaller than 200,000, just from a jobs economic base perspective.
Mm-hmm.
And then at the time, I want to be not in the top 50 on their ranking of best cities,
Right.
but
So
have a
that means that they're
significant
not
jump.
hot, quote unquote.
Yes,
Like if they're in the
exactly.
top 50, you would consider them to be a hot market. People are flocking
Absolutely.
there already. Yeah.
Yeah. And if you start looking, there's a lot of like, um, rankings of cities from population growth to job growth to just hot city lists. And
Yeah.
the same ones start to pop up, right? Like
Yep.
the Austins,
Yep.
Raleigh,
Nashville,
Provo, Utah is always up
Dallas,
there,
Fort Worth. Yeah.
Nashville. Exactly. Exactly. So I wouldn't say that that's my philosophy right now as far as
Mm,
avoiding those hot markets. I think we've got big enough and we've have enough broker relationships that we can get into some of those kind
mm-hmm.
of top markets. But at the time, it was a small property and I was looking for kind of an up and coming market. So this
Yeah.
had good population growth. It was going in the right direction year over year in those city rankings lists, but it
Mm-hmm.
was not, you know, like a Nashville.
Yeah, that makes sense. So you were looking at those. You looked at I guess, a cumulative score over multiple years. How has the city been tracking
Exactly.
in terms of growth? Where's it's been ranking? That makes sense. Um, awesome. So you selected Tallahassee. It sounds like you were still looking on near the coast. Did you look at anything in the middle? When people think of cash flow, they usually think, Indianapolis. They think, right down the center of the states. You did focus on the coast. Was
I
there
did
any thought process in there, or was it really just it was down to the list?
two things. One, I want to be able to get there and back in a day if I have to.
Mhm.
So I tend to be looking east of the Mississippi from Boston.
Yep.
And two, I want to be in cities with strong population growth.
Mm.
So the thing about a lot of the Midwest cities is, although they have high cash flow,
Yeah.
population growth is level, if not
2%,
negative,
1%. Yeah.
in a lot of them, right? And so I wanted to be in cities that had demand increasing,
Right.
rather than just sort of steady state. And the reason for that is, the sweet spot of a market is it has strong cash flow and it's transitioning into an appreciation market.
Hmm.
And I'll say like Raleigh, North Carolina, 5 years ago was that.
Yeah.
You could get good cash flow, but now it's it's a coastal city.
Yeah.
It's a five cap city. So if you can hit that transition, you can sort of get in on the cash flow and then exit on an appreciation focus model.
Yep.
So that's sort of what I was looking for. And that
Yeah.
tends to be coastal cities where people are moving to. I mean, Atlanta's not a coastal city, but it's a big metro where people are moving.
Yep. Makes sense. And so how is your strategy? How has your focus changed? I mean, that's a really good model to use, especially when you're just getting started. Eventually you find that you kind of, or at least from my perspective, you find that you kind of tap out, not necessarily tap out. There's always opportunity, but you just find that it's better to start to broaden your focus, I guess. So how has your strategy since then evolved? Have you focused only on Tallahassee, or have you started to move out and look into different cities?
Yeah, we moved out into different cities and into bigger cities, really. So, really right now we're looking at the 85 corridor. So we look for Raleigh down to Atlanta.
Oh, okay.
So Raleigh, Charlotte, upstate South Carolina, look at Columbia, South Carolina, and Atlanta. Because there's enough population and enough properties in those markets that you're seeing a good flow. So, if we just kept looking at Tallahassee, I think I just saw something come out. I think only 4 deals over 100 units have closed in Tallahassee this year.
Oh, wow.
That's just not enough volume
Yeah.
for, to be active in the market.
Makes sense.
So, I don't think you can look at too many markets. You have to be focused enough so that you can understand, okay, that's the bad area of the city real quick and just get that property right off the list. But just focusing on, say, one market, you're going to miss out on opportunities in other markets. So right now we focus on 4 major markets.
Okay. And you guys only do multifamily? Have you looked at other assets, or is it just you're focused in multifamily is the one?
We're focused in on multifamily. Yeah. I mean, I'm, interested in some other asset classes, and I've invested as an LP investor in some retail
Okay.
strip malls. But as far as our company, yeah, multifamily focused. Maybe at some point we'll have it fully dialed in and, and expand. But right now, that's the focus.
Yeah, makes sense. So let's talk a bit more about your business today. How is it structured? Do you guys have your own have you vertically integrated? Do you have your own property management company, your own contracting team? How are you kind of set up today?
Yeah, so since we're in a number of markets, so we have Tallahassee, Columbia, Atlanta, Raleigh, and Charlotte. And then I have 2 properties in Kentucky that I'm exiting shortly. So we go with third-party property management just because in-house on a distributed model is really tough to work. We are looking into, in certain markets where we start having scale, setting up property management that's dedicated. But at this point, we really rely on the expertise of the local third-party managers that we just can't get from being out of town. Their vendor relationships, their contracting relationships, their landscaping relationships. And it's gone really well. And, the key is to pick the right property management company and to develop a relationship with them and not see them as just a commodity. Really look at them like a partner.
Yep. Yeah. Finding a really good property management company, especially I would say on the smaller end, if you're looking at properties that are a little bit smaller, under the 100, apologize 1 second. All right, sorry about that, guys. I am still getting over that cold that I got like 2 weeks ago, and that lingering cough is just hanging around, and it's annoying the crap out of me. But we're dealing with it. Jumping back into this, we were talking about property management. So finding good property management, especially on the smaller end. I mean, I found for mobile home parks, for RV parks, for self storage facilities, it's really hard. How have you dealt with sourcing new property management companies?
So I've certainly had a lot of experience in this. I have three properties in the 30 unit range, in different markets. And I think that's right in that sweet spot of difficult to find property management. I think you can find good property management for condos and single families because there's a lot of property managers who are focused on that. They can kind of handle up to say 6 units solidly. And then once it gets above that, they say they can, but they're not very good at it. So then you need to find companies that sort of focus on that, say 10 to 50 units. And there's not many of those because I feel a lot of the good ones quickly realize the money's in the bigger units and they grow out of those units. But really it's recommendations,
Mm,
triangulating on brokers, lawyers, insurance brokers, lenders, who do you know that has properties this size that is happy with their property management? Or can I just talk to them and find out who they're using? And, a lot of triangulation.
yep.
And this one property in Kentucky I've had for 5 years, and I've had 5 different property managers.
Oof,
And
that
it's
sucks.
including it's a 67 unit, including an on-site handyman and leasing agent that we just hired direct,
Mm,
and just we were the property managers,
yeah.
which it went the best it did with them, but it's a lot of work.
Yeah.
And um, the minute that on-site woman moved and quit, it fell apart, and we had to bring in someone else. So certainly difficult, I would say. If you're looking at 30, 40 unit properties, make sure you definitely have a good property management company lined up and view that as the key to success for
Yeah.
that
As
property.
a resource. And I like the that you called out property managers. It's not only the work they do, it's also the people they know. So when you get a good property management team, they will know, they will have pre-existing relationships with contractors who, if you were starting up shop in this new metro yourself, you wouldn't know who to go to. These people already know. So when something happens, they can call them, they can get it taken care of pretty quickly.
Right. And they have a scale, so that person will answer the phone. If you just call up the local, I don't know, foundation specialist, and
Yeah.
they view you as a one-off job, you get treated very differently as they view you as, oh, yeah, we do, $250,000 in business with this company every year. We need to
Yep.
keep them happy.
Yep.
And that
Absolutely.
goes a long way.
So before we move into the quick question round, let's talk about the next couple of years for you guys. What does it look like? What is your goal? And yeah, what are you trying to do?
So we have 100 million in assets under management right now. We want to grow that to double that in the next 2 years. Um, and it's been very slow for the last 18 months. Interest rates kind of killed the deal volume. Multifamily is, most real estate asset classes. We're starting to see things loosen up right now. Have some interesting acquisition opportunities in process. So we're really seeing that things will start open up early next year. My general take is that everything's slow in real estate,
Yeah.
right? So early next year is probably the end of next year.
Yeah.
Uh, there's a huge time delay, and something happens. It takes a long time for it to kind of filter through and get everyone used to new pricing or new lending rates. So, we're looking at the market. We're operating our properties as efficiently as we can, constantly looking for new technology to improve the resident experience, to drive, NOI increases. But really, we're still in growth mode. Excuse me. I also have a lingering cold.
It's going around these days.
It is.
Awesome. Well, I will take that opportunity to push us into the quick question round. Are you ready?
Yeah, absolutely.
Let's do it. It starts with education. It can be anything. It could be a book you read, a conference you went to, a movie you saw. I need two recommendations, one for general life wisdom and then one for real estate.
All right. Well, general life wisdom slash business. There's a book called Who Not How, which I think is just a great book, right? And it's like a mind shift
Yeah.
idea. So when you have a problem, especially as an entrepreneur, often you're like, oh, how do I solve this problem? And the general concept is, first thing you need to think of is who's the right person to solve this problem, because you're not an expert on everything. And maybe it's you, maybe this is your sweet spot, but likely there's someone else that you can hire, partner with, work with that just does this thing and really enjoys it,
Yeah.
and get that person involved. So that's a great book, Who Not How. And then real estate. Um, I like the Cash Flow Connections podcast,
Hmm.
the Hunter Thompson podcast. I think it's
Mhm.
a good kind of deeper podcast on real like specific financing topics or waterfall structures. It's sort of kind of a deep dive. So I think that's a good resource.
Yeah.
Um,
His
for a real
I read
estate
his
podcast.
book. I can't remember what it's called. I think it was just called Raising
Like
Capital. Uh,
capital raising or something like
yeah,
that. Yeah.
something like that. Yeah,
Yeah.
that was a good one. Do you have any in person? I've been pushing the in person stuff because I personally want to get out to more conferences. So, do you
Yep.
have any good conference recommendations or anything like that that you could give the listeners?
Well, yeah, I think the National Multifamily Housing Council is sort of the Super Bowl of multifamily. I think it bounces around. I'm not sure where it is this February.
Okay.
And it's you don't even actually have to go to it. You just have to go to the hotel and set up meetings with
just
everybody and
just go rent a room and you're good.
just yeah, go rent a room, right? And get your calendar booked up. So that's a good one.
Nice. All right. Next question is for your younger self. Let's go back to that Chris who was just buying that first fourplex out there or triplex, I think, out there in Boston. Go to him, look him in the eye, give him one piece of advice moving forward.
Well, knowing what I know now, you know, real estate, it really is what I want to do. It's my passion. It's where I want to live. Um, I would have at the time I wasn't ready to start my own business. I just wasn't confident enough, didn't know enough, but I would have switched into a real estate related career so that I
Hmm.
could leverage you know, my job to gain skills
Yeah.
that would be valuable when I eventually did start my own business. And you know, as a aerospace engineer, yeah, there's a lot of translating skill sets, but I wasn't learning
Yeah.
direct things about what I ended up doing. So
Yeah.
I think it would have been take a risk, take more risks.
I think that nobody's said that yet. And I think that is really good advice because let's see, I got started in corporate in 2011 and I didn't switch over to real estate, like truly switch over until 2019. But I was doing like side flips and, single family rentals throughout that time. And that's a good point. Like the entire time I knew like real estate's in the back of my mind. I knew this is where I want to go. And that's really good advice for somebody who has that, who that about yourself. Like real estate is the end goal. Just go get a job in real estate. You could be a mortgage broker. You could be, you can even get into insurance, anything. Just get some kind of
Yeah,
job in real estate. And then when you're ready to start your own business, you can make that transition because having that knowledge, even of a service to the real estate industry, would definitely be beneficial, and all the contacts you make.
right.
Yeah,
Absolutely.
that's really good advice. We've already touched on this one a little bit, but I'm going to ask it anyways. The United States is a big place. There's tons of opportunity out there. Give me the single metro you're most excited about investing in today.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
I like Raleigh, North Carolina. It's a tough market right now. The cap rates are pretty low, but it's growing. It's got a really big base of big economic base. It kind of reminds me of like a younger Boston. It's big, good schools, heavy tech, but also has a whole diverse industrial base. So car companies, it's got battery manufacturers. So I like that area.
Perfect. Raleigh. Next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So, what is your favorite way to generate leads and find new deals?
I'm a big believer in broker relationships. So, I tend to look at, excuse me, $10 million plus acquisitions. So 10 million to 35 million acquisitions. And in that price point, you're not often going to get the buyer. I mean, the seller on the phone. Like
Yeah.
they know that their building's at least valued at $10 million. They're going to go through a broker to sell that. So what I focus on is developing broker relationships that they then go out and hit the pavement and try to pry these properties loose from sellers who may be reluctant to sell. Or so the best deals I've got are through broker relationships that are pseudo off market. So
Yeah.
broker approaches me or I talk to the broker, and they're sort of working both sides. You can tell like they're trying to convince a seller to sell while at the same time trying to convince me to buy the same property that's not actually in the market, or even maybe is on the
They're
market.
trying to get deals done.
Exactly. They're trying to make a deal. So those are, I think, where you want to live if you can.
Yeah. Yeah, I have transitioned to that. I spent the first couple of years. I thought the only way to get good deals was off market, and so I was like sending out mailers, doing cold calls, and I did get deals that way. But I have since realized that it's better to just go through brokers, because the amount of effort that you spend to find deals off market is, it's not that it's not worth it. It's just that that's their job. They are
Right.
already in that position, and you're trying to build a company, and so it's better to let them do their job, find the deals, and then you work on building the company. I know it's not rock, it was a light bulb moment for me when I realized, like, what am I doing? Why am I like pounding the pavement
Right.
trying to get these deals? These brokers are already out there, and
And they're
it's
good at it. They like decided to do that job because they like doing that job. They're like cold calling machines.
yep, yeah, exactly. All right. Next question is about lessons learned. Not every deal that we get into goes the way we expect it. In fact, most of the time something goes wrong and we get to learn a lesson. So what was a deal that went a little sideways for you? And then what was the lesson you pulled from it?
I'll say, we did a deal that we took over in Baltimore a couple of years ago, and upon takeover, we realized that the seller had dropped a lot of the bad debt from the
Mm,
financials.
mm,
So they were kind of clearing out the bad debt and carrying on their balance sheet, or deleting it, or I don't know. But I think the lesson learned from that. So what we had was a lot of tenants that weren't paying, that
yeah.
we were not prepared for, and we had to do a lot of tenant turnover in the first 6 months to a year that was not anticipated, which meant our economic occupancy was far below what our projections were, because we thought we were coming in with a stabilized building. And I think the lesson learned on that is just to do more due diligence up front,
Yep.
and to kind of push on those the financials you get from the sellers. And
Mm-hmm.
when really, do they look too clean? What's
Yep.
going on here?
Yep.
And to dig. And it's sort of interesting in real estate that you just take those at face value, right?
Yeah.
Like there's not an audit that happens when you buy a company. You go back and you like audit their financials, and that doesn't really happen in real estate. I mean, maybe in a slow market you can get away with that, but if it's a at all heated up market, no one's going to give you their bank statements for the last 3 years. So
Yeah.
just paying more attention to that side of it, like what doesn't smell right on a financial statement, and digging.
Yeah. Yeah. I'm shaking my head vigorously because we're going through a deal right now. And there were a number of things. I'm not going to give any specifics on it, but there were a number of things in their P&L that we were looking at. And they basically just didn't turn out to be exactly what they looked at on the surface level. And there were some missing expenses that weren't represented in the P&L. And when we did add that back in, it cut the NOI almost in half. And so it's just really don't take what the seller is. I don't want to say, because sellers, not all sellers are bad. I mean, they're not out trying to screw you. Some of them are, but they're not. It's just, you need to make sure to underwrite the property to make sure that the P&L makes sense to you specifically. Even if the seller says it's one thing, don't take it on face value. Dig
Right.
deeper. So yeah, good lesson.
A lot of people are underinsured out there too.
Oh yeah, good point. That's
Like just because their insurance says it's 500 a unit, your insurance is not going to be 500 a unit.
yeah. And one other thing on this same deal, not related to the first one, their property taxes. They didn't mention that they had been reassessed this year, and it had more than doubled. And so when we found out, we were like, yeah. So it's you always got to really dig deep into those numbers because you never know what's going to come up. All right. Next question is about raising capital. It does take money to make money in real estate. So what's your favorite way to raise capital?
So we raise capital kind of in two ways. One, we have a investor network that we, keep in touch with regularly and then put our deals out to, and raise through that. And then we also have two other companies that we work with on a regular basis that we partner with, and they have GP roles as well that raise capital for us.
Oh, okay.
So it's sort of like it allows my company, we're only three people. It allows us to have a bigger company feel. So the other two companies have about 5 people each. We partner kind of as a 3-company group and then raise collectively. And then we kind of divvy out what the roles and responsibilities of the whole, life cycle of the property. So it kind of allows you to do what everyone does well and to kind of dynamically change the size of your company depending on what deals you have under contract. So I think, strategic partnerships, I suppose, would be, the answer to that.
Yeah.
And we also started looking at pref equity, kind of institutional capital on some of our bigger deals, which has been interesting. How they look at it and what their metrics are has been a kind of a whole new area that has a lot of possibilities.
Yeah. Yeah, I only recently, within the last 6 months or so, realized that there's companies out there that there's groups out there that are essentially raising capital for your deals. And so if you partner with them, they'll bring the capital, they'll get the equity for the capital they bring. And it's raising capital, it takes so much time. I didn't realize that until I started doing it. But the communication that you have to have, the number of conversations you have to have, it's just like the broker. They're already out there doing it. And so you can partner with them as well. And one other question on that one, you mentioned there's 3 people in your company. What are the roles those 3 people take?
So I have myself, I am my executive assistant, and then my kind of acquisitions director, I suppose. So, me and Ryan basically split the majority activities. So he does all the front end acquisitions, major broker outreach, and he does kind of the front end asset management. And then I backfill him on both of those roles, kind of at like kind of the higher level, while I'm also running the company and raising capital. So it's a lean team. And then, our admin assistant sort of does everything. So she, fills in all the gaps.
Yep.
But I will say that we do leverage those other companies for a majority of our capital raising. So in a typical deal, we'll raise about maybe 20% of the capital, and those other groups will raise 80. They have bigger networks, and that's more of their focus. Yep. My company's focus is more inherently asset management and acquisitions.
Yep. Yeah, I mean that is the benefit of having these strategic partnerships is you can focus in on what you want to be good at. If you want to be the GP, the person who goes out there and takes the deals down, runs them, that's what you focus on. If you want to raise the capital, that's what you focus on. It really does benefit all parties to focus in on exactly your strength. So I like that you mentioned that. That brings us to the last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a 2-parter. Where can they find you? And then what can they expect when they reach out? So
I'm not a huge social media person. So I have a website, emcapitalgroup.com, and I'm pretty prevalent on LinkedIn, Chris Lento or EM Capital. And then if you reach out, I'm happy to schedule a call, talk about real estate strategy. I'm relatively easy to get in touch with. My assistant will set you up with a 20-minute meeting to introduce you to the company, what we do, who we like to work with, who we partner with, and just, I'm open to general real estate discussions as well.
Perfect. All right. I will put that link in the show notes. So if you guys want to reach out, just click the little more in the description. It'll pull down that full description in there. You can find Chris's link. All right, man. That wraps it up. Thank you very much for hopping on the show.
Yeah, I appreciate it. It was a good conversation, Gabe.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe with realestateinvestingclub.com. If you guys want to support the show, just give us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.